start to focus in on the main event then of the day and potentially of the week. Here she is, latest installment from Janet. She'll be coming to us live at 6:30. So it is a press conference meeting. Remember that these meetings only happen every 6 weeks, and it's actually only every other meeting, so therefore every 12 weeks, once a quarter, that Janet actually steps up and has a sort of Draghi-style live press conference. Okay, so also because we've got the US clocks have changed and the UK has yet to change, it does mean that we've got the Fed statement at 6 p.m. and the press conference at 6:30 p.m. rather than the typical 7 and 7:30. Okay, so Janet will be hitting the screens from 6:30. Of course, before then we have the key Fed statement or the FOMC statement that's going to be announced at 6. So let's talk about this. Of course, they're not going to hike rates. Let's have a look at the probabilities here. Just in terms of Fed fund futures, here's the effective interest rates. Now, the kind of probabilities here have pretty dramatically changed, it has to be said. But you can see here we are in March, and check this out, 100% likelihood of no interest rate hike.
On the Swiss franc.
That's according to the Fed funds futures, okay? That means that if there is a hike today, well then strap yourself in, because we're going to get some pretty sensational market reaction. Okay, I'll talk about market reaction and potential reaction in a minute, but you can see that clearly, most likely, we're not going to get a hike. So it's really more, tonight's about guidance, forward guidance. When might we expect hike number 2? And as you can see from the probabilities here, currently, Fed funds futures are pricing in a July hike. There's a 45% chance of a hike in July compared to a 37% chance of no hike. Okay, so that's the first meeting where we've got the hike probability higher. June is pretty much neck and neck though. It's dead even. So you could say right now there's like a 50-50 chance of a June hike. Okay. Obviously the April meeting, which is the next one in 6 weeks' time, we've still got a pretty substantial clear majority saying no hike. All right. What's interesting about this, you go down to November here, and even in November, we've still got a probability that there won't be 2 hikes. What the Fed funds are pricing in is that we only get 1 hike this year. Now, on the one hand, that's surprising because the Fed just 12 weeks ago told us they'd hike 4 times this year. And here we're only pricing in 1. So that it's surprising from that side. But actually, when you go back just 4 weeks, we were pricing in no hikes this year. So the kind of expectations, the probabilities have changed pretty dramatically. Let me just bring up a different screenshot now. Hang on a second. I just want to find a chart which indicates, yeah, here we go. So I'll come back to the actual market movements in a sec. Check out the chart here on the left. I'm just going to make that a little bigger if I can. So the chart on the left here, markets have repriced the Fed. So it's been a pretty phenomenal year for changes to Fed, well, and indeed economic expectations. So we had a massive dive at the beginning of the year as we had a huge risk off, and then we've had a rebound here. So, definitely expectations as a result of improving data such as GDP for Q4 2015 revised surprisingly higher. Non-farm payrolls for February, massive 242,000, very reassuring. ISM manufacturing coming in at 49.5, albeit still below 50, but really indicated a reversal of the trend, a downtrend, and perhaps now we're going to trend back up above 50. Empire State number yesterday, real surprise jump back into positive territory, indicating that manufacturing can continue to climb out of the soft patch. Retail sales yesterday, however, fortunately on the revisions for January were very bad. So we did get GDP for Q1 revised down by several banks. So just yesterday's figures just dented that optimism slightly. But still, the economic climate or the outlook going forward definitely changed. And so our Fed rate hike expectations have changed with it. All right. So today, as I said, it's not about are they going to hike, it's about when are they going to hike next. So let's check out the Fed dot plot, because this is how they're going to communicate this to us. This is the dot plot right here, and what this is showing, so they update this once every 12 weeks, and of course what happens is all the members get to give us an indication as to where they think rates are going to be at the end of each year. Okay, so right now we have the dot plot telling us, and this was from December's meeting, telling us by the end of this year the average would be 1.375%. That's the end of 2016 interest rates. Now currently they're at 0.5, and so to get there we need more than 3 hikes. Okay, more than 3 hikes to get to 1.375%. 2017, 4 hikes in 2017 to get us up to 2.375, and then basically just under 4 hikes in 2018. Okay, so it was always very much 4 hikes a year. That's what we were told in December when they first hiked rates. Okay, but of course here we are now. If we're on a 4 hike a year rate or speed, they need to hike today. They need to hike once at the end of each quarter if they want to hike 4 times. So it's very unlikely they're going to hike 4 times, of course, and it's much more likely they're going to hike 3 times max, maybe twice, and as the Fed funds futures are telling us, just once. Okay, I'm expecting today's overall event to be mildly hawkish. You know, I do think that the Fed funds futures are wrong in terms of pricing in just 1 hike. Here's a chart looking at the Fed dot plot matrix, but actually now bringing in market expectations. And as you can see, and this has been the case all year, and indeed when they hiked in December, the market's always priced in quite a bit less than what the Fed has been telling us. So I actually think now the market's perhaps too dovish, and I think the Fed at 4 hikes a year is of course too hawkish, and I think what we're going to get is somewhere in the middle. I actually think 3 hikes, personally. And I actually think the best case scenario for the global economy would be 3 hikes. And that is because the only way the Fed are going to be able to hike 3 times is if the economy is strong. And if the US economy is strong, well, then that certainly helps out with growth globally. So best case scenario for the whole planet is 3 hikes. Whether they actually get to do that or not, of course, remains to be seen. But I think what the Fed want to deliver tonight in terms of a message is one of confidence. It's their job to try and instill confidence. And so I think they're not going to change too much. I mean, of course, at 6 o'clock, we're going to get the Fed statement. Okay. Now, this is a look at the Fed's statement from January, the last meeting, and showing how it changed compared to the meeting before that in December. So this is just a document that has the changes tracked on it. So the December meeting statement, where the words have been crossed out, that was December, and the green highlighted words were used to replace what's been crossed out. So for example, in December, the Fed suggested economic activity has been expanding at a moderate pace, but then in January they said labor market conditions improved further even as economic growth slowed late last year. So, these little sentences here are very important with regards to guidance going forward. Are they going to change this sentence in terms of how they describe the economic activity? So they said economic growth slowed late last year. So what do we think they're going to, how are they going to change that sentence? Well, here's quite a good sort of table Nomura have put together, which is actually pretty interesting and insightful. And so they've got, right, so economic growth, what did they say last time? So they said that it slowed late last year. What do we expect them to say this time? And Nomura expect them to say economic activity grew at a modest pace at the start of this year. Okay, so this is how this is how Nomura are expecting the statement to change. Look how many no changes they've got in here. So actually, we're not expecting much of a change. I know we've had a real dive in sentiment and then a real rebound. And so, in fact, if anything, we're kind of not far off back to where we were. So therefore, the Fed might be able to get away with really not changing much here. We're expecting the inflation comment to change from continue to run below target to has picked up but continues to run below target. So that what they're trying to say there is inflation has gone higher, but it's still low. Now, this is quite an interesting situation, I think, on the inflation front. If I just show you a chart on inflation, we just go back up here and have a look at this chart from the Danske Bank report here. The chart on inflation. Look at how this has changed. This is a long-term chart over several years. And look at how all of a sudden inflation conditions have suddenly ramped quite sharply higher. Now, the Fed have had the luxury, the bonus of very low inflation to help support and justify their dovish stance. They're very quickly losing that tool. The inflation outlook's changed quite sharply, and they're very quickly not going to be able to use low inflation as an excuse to be dovish. So I think that ultimately the Fed are going to say that data in recent weeks has been reassuring, that the economic resilience of the US economy is still strong, and that ultimately we need to get some firepower to fight the next recession. So I think they're going to deliver a mildly hawkish statement. I think they're going to, of course, keep the door open. You know, every meeting's a live meeting and that we're data dependent. You know, this is the standard line. They're not going to change that. And what normally happens is the statement is more hawkish than Yellen herself is, who's slightly more dovish in the press conference. But actually, the last two Fed events have actually passed off without much market reaction at all. I mean, Yellen absolutely nailed it in the last two meetings in terms of not creating any market volatility. So she's got history here, and maybe we're going to get another scenario where she's going to be mildly hawkish. We're going to be reassured by that, and ultimately we won't get too much reaction. Right, what else to kind of show you? The other thing, let's look back at this dot plot. I'm going to go back to this chart here, because what we need to focus on is how they're going to change the dot plot. So looking at the 2016 dots. So this is in December. Where did the Fed members individually think interest rates would be at the end of 2016? Okay, so these are going to change. And obviously, as we go through 2016, these dots are going to converge. And as they did in 2015, obviously, they all converged to one hike, which is indeed then what happened. So here we're going to get these dots changed. Okay. Now, the point here is 10 dots. That's 10 of the 17, are there? 1, 2, 3, 4, 5, 6, 7, 10. The 17 dots, right? 10 of the 17 are currently above 3 hikes. So the actual median here is 1.375. To get to 1.375, we need more than 3 hikes. We need 3 and a bit hikes. So we've actually got 10 of the 17 at more than 3 hikes this year, except unless they hike today, they're not going to be able to hike more than 3 times realistically. So my point is that 10 of the 17 dots are most likely going to get revised down. Okay, now how far down obviously is going to be key, but the point here is the end of 2016 median dot plot is going to drop, and really the big question is by how much. Now, if it's going to be 3 hikes this year, it's actually only going to drop to 1.25. If it drops to 1%, that's 2 hikes, and that actually would end up being dovish. I think the markets would react dovishly, even though the market's already pricing in 1, if that makes any sense. But I think from the Fed's point of view, if they revise, if the 2016 median dot plot is 1%, that's dovish. If it stays where it is at 1.375%, that's hawkish. If it drops to 1.25, I'd say that's mildly hawkish. Anything below 1.25, and then it starts to become dovish. This is the focus here. I actually think pretty much forget everything else. What's the end of 2016 median Fed dot plot? That's what it's all about tonight. And we're going to find that out at the statement when it's released at 6 o'clock. let's have a look at the markets here. Obviously, I've got these on daily charts. Obviously, we've had a real ramp up in risk appetite in the last 4 weeks, and the S&P is just treading water around 2,000. Currently, we've had 3 dojis in a row. We had that lift higher in the end on Friday, delayed positive reaction to Draghi Thursday, and we're still right up here, okay? In terms of the dollar, well, the dollar's been weak, but not because of the dollar, really because of the euro. And, we've been stubbornly finding support around the 111 handle, just testing the the December high here today at 110.88. So the biggest move today for the dollar will be dollar strength. And that would be dollar strength off a hawkish statement. Let's say the Fed's dot plot stays at 1.25% or higher for 2016. Then you're going to get some dollar strength. Look for a key break below 110.88 and a move down to 110. So I think the biggest move for the dollar would be off a hawkish statement and dollar strength because the dollar's weakened. And actually, those out there are some massive contrarians who think they're going to hike today. Here's an angle for the Fed. You could make a claim to justify a hike today, and that would be that, look, the dollar's quite weak. If you look back over the last few months, the dollar's relative to the euro quite weak. So actually, we've got a bit of space here to hike rates, and the dollar will strengthen, but it won't strengthen beyond the kind of values we've been seeing on average for, let's say, the last 6 months. So they've got a bit of room here on the dollar to actually hike. You could say the inflation situation is starting to look a little bit hot, with inflation ticking up quite fast. So why not get on with it and contain that? Also, we're running out of time in terms of when the next recession's coming. So again, let's just get on with it and try and hike rates as fast as we can. Let's just go for 4 hikes this year. Hopefully, we'll just send a message of confidence that we think that the economy is solid. So there is an argument to hike today, and if that did happen, well, you are going to see some price action. If they did hike, the dollar's going to be down through 108, 107 wouldn't be beyond the realms of possibility. If they hike today, then certainly equities would suffer. You're going to get the S&P coming off strongly. I think it's difficult with the S&P when you think about this idea that they're going to hike 3 times. If they deliver a dot plot that gives us a 1.25% end of 2016 rate, well, then that is hawkish, it's mildly hawkish. But as I've been saying, surely the best possible scenario for the economy is we get 3 hikes. That shows the economy is strong and can deal with that many hikes. And so I think, certainly in the short term, let's say tonight, the S&P will react negatively to hawkishness. But as long as the Fed's not too hawkish, then there is grounds, given that what Draghi's just done last week, of course, and oil's kind of maintaining its higher price point, there is grounds to say that a mildly hawkish Fed is perhaps the best possible scenario for risk assets. It might not be that that's the immediate reaction, but it might be that that is the reaction as we kind of go into the weekend. So I think dovishness, I think actually dovishness isn't necessarily a good thing for equities. I think that ultimately we're worried that monetary policy might fail, and ultimately we want to see the Fed hike just to justify and reassure us that monetary policy isn't going to fail. So I think trading equities tonight might be quite tricky. I think trading the dollar, dovishness, there is upside potential for euro dollar, but not much because we've already jumped a lot higher. But yet, the Draghi high at 112.40, for example. Let's have a very quick look at T-notes, because T-notes have been dropping quite consistently over the last 4 weeks as risk appetite has returned. Yields have risen as we price back in a Fed rate hike. We're down below the 50% fib of the year here. And so, the Fed, and today we had a bit of a drop on, this is the 1 hour chart, we had a drop, a continuation of this downtrend this morning. So you are getting a little bit of hawkishness in the bond markets ahead of the event. And so therefore, dovishness would be the big surprise here. A bond market rally off dovishness would be the bigger move. We've got mild hawkishness priced in already, I would say. Okay, and the just final point to make really is just to say that, you know, you're going to get normally a lot of price action and volatility off this, and therefore you've got to be careful. There are two stages. You do get a lot of information from the Fed at the statement release. And basically, most of the info is going to be at the statement release. And then it's Yellen's job to read out the statement and then answer the financial press's questions, of course, 6:30 onwards. Normally, if it's a normal pattern, you get the statement being slightly more hawkish than the press conference. But Yellen has steered through these events quite successfully in the last couple of occasions. And so don't get your hopes up for major moves here. This isn't going to be a Draghi day. Unless the Fed hike, this is not going to be as big an event as we got last Thursday. Okay, so we've got 1 hour and 40 minutes until the statement. We've got 2 hours and 10 minutes until Yellen steps up. So good luck and see you on the other side.